Welcome back to the Deep Dive. If you just glanced at the market headlines today, Tuesday, December 9th, you'd see a picture of, well, unnerving calm. U.S. equities saw only these modest, orderly declines. The S&P 500 drifted down less than 0.5%.
And the Nasdaq, the real heavyweight, was barely scratched.
Exactly.
It looks quiet, doesn't it? The S&P closed right there in that 6,841 to 6,846 range. Nasdaq, what, off 0.14%? It suggests, a very neutral sentiment.
Right, because everyone is just waiting.
They're waiting for one thing. The market has already priced in the big event tomorrow, that highly anticipated Federal Reserve rate cut.
But the surface is always, always deceptive, especially in these tight liquidity environments. And that's our mission today, to get right under that calm surface.
Right.
We want to apply that institutional analytical framework to understand what the smart money is really doing. We need to know the true risk profile of this market, not just the index price, going into the FOMC announcement tomorrow.
Precisely. We're moving beyond just price action. We have to dissect the volatility term structure, look for those dark pool signatures, and critically figure out which structural correlations are starting to break down.
And that combination of non-price data, that's what reveals the true conviction.
Or, in this case, the lack of it among the really sophisticated investors.
Okay, so let's unpack the positioning. The fact that the market easing was orderly, that's one thing. But the glaring outperformance of the Nasdaq, closing near 23,530, that's our first real clue about where capital is hiding. Why is this AI supercycle thesis still providing such strong sort of scaffolding for the market?
It's the conviction trade of this entire cycle. I mean, even if a portfolio manager is trimming broad exposure ahead of the Fed, and why wouldn't you on a binary event?
Sure.
They are still maintaining or even selectively adding in those high conviction growth areas. Semiconductors, infrastructure, software. It's a way of being cautious on the index level, but still aggressively committed to a theme.
But that concentration, it has at its own risk.
Oh, absolutely.
Feels like risk management through a magnifying glass. Speaking of risk, let's talk about the VIX. The volatility index firmed up a little on the 9th, hit about 17.04.
Yeah.
But the real tell, the real institutional anxiety, that happened the day before, on December 8th.
What's so fascinating there is you get this crystal clear signal of aggressive tactical event risk hedging. We just saw this huge surge in institutional buying of out-of-the-money put options.
They were paying up for insurance.
Paying up for insurance, specifically against a tail risk outcome from the Fed. And that's what pushed the VIX up a full 9% to 16.1 on Monday.
So they're buying a parachute even if they assume they won't have to pull the cord. But we have to view this through the lens of the overall liquidity environment. I mean, this isn't a happy, fat market anymore.
Not at all.
How does that systemic liquidity tightening we've seen since 2022 color this whole picture?
It just makes everything more fragile. We've seen these liquidity vacuums and just really shallow liquidity in other asset classes. Look at digital assets or even overseas in places like India's Dalal Street. And if that shallow liquidity is reflected here, which, we infer it is, it means price moves, even small ones like that drift we saw on Tuesday, they just require far less volume to actually happen.
Okay, let me just challenge that for a second for the listener. If the market is moving on less volume but still dropping, does that suggest the big institutions just aren't selling? Or is it that the market's shock absorbers, the market makers, are just operating with thinner books?
It's mostly the latter. It means the elasticity of the market is low. So if an unexpected shock hits, let's say we get that hawkish cut we'll talk about, the drop in price is just amplified because there are fewer bids sitting there waiting to absorb the selling.
The system is brittle.
It's brittle. And that brittleness is the absolute foundation for the asymmetric risk we need to talk about.
Brittle is the perfect word. Okay, that brings us to the core of this, the institutional analytical framework. We move past price and we look at those three non-price indicators: market breadth, volatility term structure, and dark pool signatures.
And we use these to understand if the modest strength we've seen is, truly broad-based and healthy, or if it's narrow and really vulnerable.
Let's start with breadth, the advanced decline line. We saw a positive ratio, something like 1.3 advancers for every 1 decliner. That sounds okay, right?
It's acceptable, but it is a long, long way from overwhelming conviction. The real yellow flag, though, it waves fiercely when you look at participation across the different market caps.
And specifically, you're talking about the small caps. What are the small cap indices, like the Russell 2000, telling us?
They are just lagging, significantly and persistently behind the S&P 500, and this is the classic sign of thin market leadership.
So the whole rally is just a handful of stocks.
A handful of mega cap stocks, exactly. The AI names we just mentioned, if the top 5 names are responsible for, say, 70% of the movement, the underlying economy, which is represented by those small caps, is clearly either struggling or it's anticipating higher credit risk.
And if the Russell 2000 can't keep pace, it's telling you fund managers are still worried about domestic consumption or the cost of capital.
Right.
Concerns that a few global tech giants just don't really share.
Yeah.
This tells you the bullish story is narrow. It's not systemic.
Precisely. And if those few leaders stumble, say one of the big semi-firms issues a revised outlook, there is no broad market participation ready to cushion that fall. The risk is all concentrated in just a few spots.
Okay, so we have narrow participation and active event hedging. Let's shift to that second indicator, volatility structure. We've established that immediate fear is low, but what happens when we look further out on the VIX futures curve? Are we looking at complacency or stress?
Well, a healthy market is typically in what we call contango. That just means the VIX futures curve is sloping upwards. You pay more for volatility insurance 6 months from now than you do for next month.
Because more can go wrong in 6 months.
Distant uncertainty should demand a higher premium. Simple as that.
And what we are seeing is not healthy contango.
Not even close. We're seeing a noticeable flattening of that term structure. And critically, there is a slight hump that's forming in the midterm contract, so 3 to 6 months out.
This is where it gets really analytical. Explain that hump. If the front of the curve is calm, but the middle is rising, what anxiety is the market pricing in for mid-2026?
It means investors are they're comfortable with the known binary outcome tomorrow. The rate cut is priced in, but they are deeply concerned about what happens after the Fed acts. That hump signals this underlying structural anxiety about future macro events.
So things like?
Well, maybe it's the full effect of the cumulative rate cycle finally hitting, or maybe it's geopolitical stuff, or even the U.S. election outcome later in 2026.
So they're not worried about today's event. They're worried about the unknowable stuff, 6 months to a year out. They're structurally cautious, not just momentarily fearful.
It's a very key distinction. Short-term relief that is masking some serious intermediate-term caution.
All right, let's move to the third pillar, flow signatures. We have to look into the dark pools to see the footprints of the really patient, large-scale institutional money.
Right, so dark pools are those private off-exchange venues. They're used for executing huge block trades quietly to minimize the market impact. They really reveal true institutional conviction because you don't want to tip your hand on the public exchanges.
So what were the dark pool prints showing on Tuesday when the market was just drifting a little lower?
We saw 2 things. First, we saw that concentrated large block buying the accumulation in those select mega cap tech names we keep talking about.
Okay, that confirms the narrow rally idea.
It does, but here's the key contradiction that suggests a real lack of broad conviction. At the same time, we saw this noticeable uptick in large signature prints for the SPY ETF, the big S&P 500 tracker executed predominantly at bid-side prices in the late afternoon.
Hold on, let's break that down. For listeners who aren't familiar with the mechanics, executing at bid-side prices means you're willing to sell at the highest price a buyer is currently offering. You're accepting a slightly worse price for speed.
For immediate liquidity, exactly. It suggests either urgency or very patient offloading. It implies that while maybe the fast money was pushing the market a bit higher, the large, patient institutional players were actively using that minus strength as cover.
So they weren't buying into the strength.
No, they were discreetly setting up hedges or just reducing their core index positions. They were not chasing this. They were using it to reduce their footprint.
Wait, but isn't that just smart cost management? I mean, how do we know it signals a fundamental lack of conviction instead of just efficient, quiet execution?
Because if they had conviction, they'd be buying the whole index at the ask side. They'd be aggressively accumulating. Instead, they're supplying shares at the bid. And when you combine the strategic unloading with that systemic liquidity vacuum we discussed, it just screams that these managers do not have the conviction to deploy significant capital broadly ahead of the Fed. They are managing their liquidity, which is the most critical thing when the whole system is this tight.
So this paints a picture where a huge chunk of professional money is using this perceived calm, this neutral sentiment, to actively reduce risk, not pile into it. Okay. Now let's connect all this to the final piece, correlation breakdowns. This has to be the structural issue that portfolio managers fear the most.
This is maybe the most challenging finding in our source material. When asset classes stop behaving like they should, the entire premise of traditional portfolio diversification just it gets wrecked.
Give us the specifics on the traditional safe havens.
Okay, first, gold. Historically, gold is your crisis ballast, right?
Right.
Equities drop, gold should rise as a safe haven. However, reports are now noting an unprecedented, simultaneous, explosive territory for both gold and equities in recent quarters. If they're moving up together, that historical hedge value it's severely eroded. Gold starts to look less like a hedge and more like just another directional bet on risk appetite.
So your gold hedge just becomes an amplifier if the market drops hard.
Yeah.
Wow. What about the ultimate safety valve? Bonds.
And that's the most concerning breakdown. The traditional flight to safety trade relies on a strong negative correlation between equities and long-duration treasuries. Stocks melt down, bond yields drop, and bond prices rally.
The classic playbook.
But our sources are pointing to this correlation now, showing a slight but really meaningful positive drift.
That is terrifying, because it means if that hawkish disappointment scenario plays out tomorrow and equities drop, your long-duration bonds might also drop, or at least they might fail to give you that capital buffer you need.
So where do you hide?
Where do you hide if the ultimate defensive assets start moving with risk?
It forces PMs to get extremely creative with derivatives or just move to cash. The whole structure is fragmented, which, it just confirms our market breadth problem. The market cap weighted S&P 500 is diverging significantly from the equal weighted S&P 500.
It's a structurally unsound market.
Highly prone to volatility spikes.
Okay, so all these indicators, narrow breadth, a stressed VIX term structure, discrete dark pool selling, broken diversification, it all leads us to the pivot.
Yeah.
The asymmetric setup for the FOMC decision tomorrow.
The outcome itself is virtually a done deal. We know the Fed is cutting 25 basis points. The probability is sitting at, 89.4%? The actual cut is irrelevant noise. The market move depends entirely on the forward guidance from Chairman Powell's press conference.
So let's define the scenarios based on the framework we just built. What's the upside, the dovish surprise?
The upside would require Powell to signal a much steeper cutting path into early 2026. More cuts than anyone is anticipating. If he delivers that truly dovish signal, the tight liquidity and the low implied vol on the front end could trigger a very sharp risk-on rally, specifically benefiting those rate-sensitive sectors that have lagged, small caps and financials.
But the institutional conversation is all focused on the downside because of that inherent asymmetry of risk. The market's already priced for good news. What happens if we get the hawkish cut?
This is the greater asymmetric risk. The hawkish cut is where they deliver the 25 basis point cut, but they wrap it in extremely cautious language. Maybe they imply it's a one-and-done cut for now, or suggest the committee is really divided.
Which would pull the rug out from under the nearly 90% who are positioned for more easing. And given the market structure, why would the resulting correction be so amplified?
This is where we need to touch on negative gamma. Market makers sell options, especially those 0 DTE, 0 days to expiration options around key price levels like 6,850. If the price moves against them, in this case dropping hard after the hawkish cut, they are forced to aggressively sell the underlying index to hedge their own risk.
So negative gamma, that translates options jargon into real panic. It forces market makers to sell into a falling market, which just accelerates the correction. They become dynamic sellers.
Precisely. It turns the market maker from a stabilizing force into an accelerating force on the downside. And given the low liquidity we talked about, that sudden selling pressure would hit hard and fast.
So for you listening and trying to apply this, what are the critical intraday levels to watch during that volatile 2.00 p.m. to 2.3 p.m. window?
You have to focus on the S&P 500 futures range of 6,800 to 6,900. This tight 100-point band, it acts as established support and resistance, largely because of the positive gamma pockets, the price magnets, from all those 0 DTE option sellers.
And 6,000 to 850.
6,850 is the critical pivot. It's the magnet level where gamma exposure is highest. A decisive break and hold below 6,800 after the announcement would be the institutional signal that the hawkish disappointment is playing out and that the options-driven correction is underway.
That's the signal for downside momentum.
That's the signal.
So to summarize the institutional reality on the cusp of this massive decision, while headlines suggest neutral sentiment, the underlying truth is one of extreme caution. We have narrow participation, we have strategic hedging with put options, and flow analysis suggesting big players are using any strength to discreetly reduce risk.
And this market is just structurally fragile because of that thin liquidity and the correlation breakdowns.
Oh.
That fragility makes it hypersensitive to the nuance of Powell's language. The cut is irrelevant. The future path is everything, and the downside risk is significantly amplified by these options mechanics.
Which brings us to our final provocative thought for you, the listener, as you digest all this. We've established that volatility is subdued short-term, yet the VIX term structure, these correlation breakdowns, they signal really deep-seated structural issues. So if your traditional safe havens like gold and long-duration treasuries are failing to reliably diversify risk, where does a portfolio manager hide? That is the core portfolio construction problem the pros must fundamentally solve to prepare for the inevitable volatility spike in 2026.
Stay selective, respect the tight liquidity, and watch those gamma levels.
That's it for this deep dive. We'll catch you next time.